I'm Charlotte McLeod with investingnews.com, and here today with me are Rob Crayfourd and Keith Watson. They are co-fund managers at Golden Prospect Precious Metals and CQS Natural Resources Growth and Income. Thank you so much for being here. Great to have you.
Thank you.
Thank you.
Really good to be catching up with you. We had a while back a great conversation on uranium, and today we're going to go in the direction of precious metals, especially gold and silver. So gold, of course, we know has been in focus in 2025, and there are a lot of factors behind its price rise. I thought I would start by asking you what you see as the main drivers of gold right now. And of course, either of you can feel free to jump in at any time.
Well, yeah, I mean, we could take up the whole interview with that, but yeah, look, I mean, what's quite clear is the main drivers more recently have been central bank demand. So central bank demand and bar and coin driven by retail. So the drivers behind that are pretty similar, but really on the central bank side, that kind of started in the post Russia invasion of Ukraine, and we saw central bank demand pick up. We have had 15 years of buying, but we saw a notable step up. More recently, we've then had US trade war, US global trade war, and that's only going to lead more central bank demand going forward. And we've seen a further step up from that already elevated level. So, the Russian invasion of Ukraine really started the sort of question mark around US treasuries as holding to central banks. And therefore led to a greater allocation towards gold. And what we've seen with the trade war is that just further emphasizes that point, and we're going to see more buying by central banks. So this is what we think is quite interesting, is that we've been making new all-time highs on gold, and it's almost entirely been driven by the strong central bank demand and by retail bar and coin, which has primarily been led in EM, emerging markets. And that's been driven by retail who are focused on potential devaluation of their own domestic currencies. And by buying gold, they can protect themselves against that. So moving forward into where we are, into what we're seeing going forward in this trade war scenario, is there's greater uncertainty about the direction of their own domestic currencies. And that just further supports retail bar and coin. So that's what we've been seeing so far. And actually, given the macro backdrop, we see further upside to those aspects. Without kind of talking too long in one stint, the thing that kind of excites us actually is we believe there's more and more motivation for financial market players to come in and start buying both the physical and buying the miners.
Okay, very, very good overview there of what's going on in gold. And I know that's a huge question to start with, but I think it gives us a good point to kind of jump off here. One of the points I want to hone in on is that currency devaluation angle. I think that's becoming more and more something that's front of mind for an increasing number of people. And if we look over at the US, maybe we take a look at some current events right now, because the US debt is really in focus as we have the big, beautiful bill trying to make progress over there. Yeah. So anything further you would add on that angle and kind of that growing awareness of this massive problem?
I'll step in at that point. I think this whole trade war process has really refocused people on the underlying issue, which is the effort to address the rising deficit ultimately. And unfortunately, I think the policy approach, which has been fairly bluntly implemented by Trump to raise taxes from foreign imports, is failing in terms of raising enough money to make a difference. The Doge cost reduction initiatives from the now having left Musk side of things has failed to deliver many meaningful or sustainable cost reductions. And now we're talking about tax giveaways. And I think in any event, we've got, something like 25% of US treasuries reset at 4% in this year. And, the interest bill alone on the 36 trillion of debt liabilities that the US have is, 1.5 trillion. And it's a number that's just going up. And I think that does come full circle into, what is the outcome of that? And ultimately it is inflation. And the only way to actually get rid of debt is to inflate it away. And one of the best ways to protect yourself from that is probably gold as a wealth protection. And, gold has done well, but actually the main point that we would put across is that equities have really lagged that move up. And it's nice to see in one respect that gold has diverged quite materially now from what we would class as lazy investment style of just following the S&P, which has essentially been the Mag 7, because gold has been performing very well despite an increase in the rise in long-term yields, which reflect the very fears of this overburdensome debt pile that isn't just in the US, it's actually in lots of developed markets. And that, I think, is ultimately why central banks now realise that they've got to increase their foreign currency reserves to include gold. And, the pace of buying has stepped up materially, as Rob said, post Russia-Ukraine and the COVID, which in any other word would have been QE4. And we're probably facing a QE4, and we haven't even got off quantitative tightening now. So there's a big whirlpool of, nastiness out there. And I think, the one point that we would really like to get across is that insurance for your wealth is actually very cheap in the context of the gold price at the moment. It's cheaper now than it was over 10 years ago. Just buy some gold equities. And that sounds a little bit like a soapbox preach, but I do think there is a role for that, because we might just be at a turning point, both in terms of long-term inflation trends, which in the US might actually be stagflation, and a very difficult way out of a overburdened debt borrowing requirement. And, meanwhile, growth is going down. We've yet to see the full effects of these tariffs show through in fundamental data. It's on, off, but, the quarterly data that we've got's only got a small portion of that in. And I think people are rightly worried. The thing that surprises us is that equities have not re-rated. And I'm sure Rob can talk about some other issues that might add some spice to the equities, in particular the cost outlook. But, that's the fact.
Also, really good points on what's going on right now. And definitely let's move over and talk about the gold equities, because I know you got a big focus there. So where are you seeing the most opportunity right now? You're talking about this disconnect that we've seen in terms of how far the gold price has moved and the gold equities have not quite caught up. I know in terms of the larger miners, we are starting to see some movement there. So for you, what's your focus and where are you seeing that big opportunity?
Yeah, I mean, if we look at what the equities have done, the mining equities relative to gold, as we've kind of seen a bit more of a kind of one-to-one correlation. We would anticipate that you'd see operating leverage, and you would anticipate operating leverage. So, if you're a gold miner, so I'm just getting some feedback here. If you're a gold miner, say producing at $1,000 per ounce and gold's at 2,000, and then you go to 3,000, gold goes to 3,000, then your margin doubles. So you should get a 2-to-1 correlation. But the reality is we just haven't seen that. We've seen a kind of 1-to-1 correlation. And as a result, the equities are looking cheaper now than they have done in history on our estimates. So our belief is there's a real catch-up trade to come from the equities to catch up with gold. But then the question mark is why is that happening? So if we look at the sort of post-COVID period where gold stocks rallied, ultimately they then saw a big bout of cost inflation, which ended up squeezing their margins back to something comparable to the pre-COVID period. And I think for sort of generalist investors, there's an assumption that precious metal miners aren't great companies. They're going to end up doing similar. Costs will blow up. They'll go and do some poor M&A or hedge at the wrong time. We think there's actually a very different dynamic that we're looking at now. If we actually look at the inputs to major cost inputs, so whether it's oil is trending lower. It looks like we're going into a kind of oil market share war with OPEC. Steel is heading lower, and in the backdrop of weak Chinese property sector, labour is materially easing up, with other mining sectors also kind of generally a bit softer. So all of the major inputs are actually falling. FX, which you touched on, most of the major mining regions' FX currencies, whether it's Canadian dollar, peso, Australian dollar, have generally been weaker in this kind of trade war fear. So again, that just makes costs lower. So as a result, we think there is much more translation from higher gold price into their earnings, and thus the miners themselves should have been getting more of an operating leveraged move into this gold price. So snapshot where we are today, stocks look cheap. They're generating somewhere near record earnings. So what changes that? Ultimately, it needs to bring back generalists into the sector, and we really don't believe we've seen much of that yet. We look to things like the big ETFs, the VanEck gold miners or VanEck Junior, and they've just got collapsing share counts. So as gold prices rallied and the indexes have gone up in value, retail and generalists that are owned by ETFs have just been selling into the market, taking profits, which is sort of counterintuitive to what you'd expect. You'd think people would be seeing the better opportunity, better fundamentals and buying. So, despite the move higher in the names themselves, we're actually very constructive on the outlook because firstly, the top down is very attractive for the macro that we talked on, and the bottom up is as attractive as we've seen it. And we think there's a real catch-up trade for generalists and retail to kind of come in and try and catch up just to get back to more normalized multiples. So that's why we like the miners, and we think they offer more upside than the precious itself. But ultimately, we think all are attractive.
Okay, very good. So many points we can pick up there. I want to ask you a little bit more about the generalist investors and what might draw them into the space, because I think over the months and years, I've heard various things that this will be the trigger where they come in. Is it 2,000 gold or 2,500, 3,000? And it still seems like they're not there. So do they just need to see continued strong results, or what do you think?
Yeah, well, we're definitely pressing our holdings to kind of, the way we're structured anyway is that we kind of have a bit more of a tilt towards kind of smaller cap names. So we kind of like to sit around that kind of 500 million to a couple of billion range. So we're not in the mega caps. But I think as an industry, one thing we're really pressing for is more buybacks, more dividends, because I think that's the thing that generalists often look to. The balance sheets are super strong for the sector overall. Cash generation is at record highs, and we're going to see improving cash piles. But so far, we have seen dividend increases, big proportional increases, but from a very low base. So it's not quite enough to really kind of draw generalist interest. Generalists that we speak to are generally kind of a bit put off kind of doing single name stocks because they feel like they're a bit of an information disadvantage. But the reality is, I think there's been a real kind of extended period where a lot of generalists are just able to ignore it because it's a relatively small portion of their overall benchmark. Kind of maybe less so in Canada, or it's a bit more relevant, but on a global level, everyone's kind of been overweight US and overweight tech, and we're seeing that kind of reversal now with money rotating back into Europe, and doesn't really feel like it's had many eyeballs on it. But with improving earnings, if they kind of evidence that through buybacks and dividends and solid balance sheets, don't do any stupid M&A, don't start to hedge. These are the things. Ultimately, the one thing that the market can't ignore is free cash flow and cash generation, and I think that's kind of one of the key aspects that can really kind of bring that re-rate and flows back into the sector.
All right. And I think we should also definitely take a look at your criteria for selecting companies for the funds. I don't know if you can mention any of the names. If not, maybe just some of the criteria that you use when you are looking for these companies that have strong potential.
Yep. I think the one thing that to some extent it changes over time. At the moment, we see that there's better value in producers than there is in, say, the developers. Yes, we see some of the inflation pressures are easing, and in some inputs, next year will hopefully be a bit lower, such as energy and oil costs. That plays into the likes of the big strip ratio open pits. Another aspect is, the fact that labour in regions such as Australia is also starting to ease up. But at its worst, I think some 600 IPOs had taken place in Western Australia during COVID, raising hundreds of millions for projects that were predominantly based in Western Australia, all competing for the same labour pool that couldn't move because Western Australia closed its borders. And we saw huge wage inflation erode the margin gain that could have been felt there. And those type of factors are unwinding in that type of region. And actually the currencies against the dollar are doing, what they do in the longer term, which is, the dollar is still placed that in broad terms is fairly strong. Gold price in non-dollar currencies is done better over the piece. In terms of our style, we look for those producers that can probably withstand a degree of gold price temporary fall. A good few $100 won't result in dilution. We look for assets that have got, I think this is a crucial point and it sounds a bit hackneyed, a good track record management team. And if you looked at the top 10 investments that we've got, we feel that those are, in the main, those that can deliver on time and budget and have done so previously. And we want an ore body which is scalable and a bit of flexibility to it that will generate funds for them to self-fund their own growth. And again, most of the projects that you'll note in our top 10 that are producers have self-funded growth. And they're in a market cap range which is just below that which is of interest to the generalists and, that have some kind of liquidity requirement. And we look for catalysts. So not only do they have to have good management, a good ore body and an attractive valuation, we then look for the outlook for the news flow on them to deliver on that growth profile. And that in broad strokes is the type of approach that we take. And, there may be some other nuances to it, but in large part, that's what we're looking at. I'd say for preference, we're not put off by, underground mining, even though the reserve life might be slightly shorter. And again, that by having a shorter reserve life, it means that your net asset value is lower, so your price to net asset value can often be higher for, an underground vein operator. But equally, we would like to be comfortable that once they're underground, they can drill and add to that resource and reserve life and extend it. And that's certainly something that's coming true in names that, we feel are like Greatland Gold that has acquired an asset from the 70% interest that it didn't formally own at a very good rate, effectively got a huge stockpile for free, and is now in the process of developing an underground operation at Havieron to fill the Telfer mill, and has other optionality with assets that surround it, and a management team that has been basically building up to this process that's allowed it to deliver good news and then get it introduced into the ASX and different indices that build up and sustain that share price momentum on what is still a very low valuation as it's done so. So, that would be a classic example of one of the more recent contributors to performance. But companies like Emerald Resources that Morgan Hart, formerly of Regis, he has a reputation with his team of delivering new mines for roughly, even others in the industry would say is about half anyone else's capability. And, over a number of occasions, both at Regis and then subsequently with Emerald, he has proved his worth. And, now he's already stepped forward with another mine that he's acquired in Australia, and he has stepped forward into other longer term development assets that, they will capture value from. And, that is another one that actually had outperformed the sector some 12 months ago, and as a result of which we took some profits to reinvest in other names like Greatland back then. And, now it's lagged a little bit over that period of time compared to the rest of the sector. So we're putting money back into the likes of Emerald. And that gives you a flavour for some of the repositioning that we can do within the portfolio, not just taking new names, but within companies that don't always move in lockstep.
Yeah, I think those are some great points, and it gives a good idea of your strategy there. I was going to ask about the management style or strategy in terms of how active you are. So anything further you would add on that front?
I would say, we just have a watch list, activity. We don't try and overly turn the portfolio. We just, we like management teams and we try and time it as best we can. We don't lose faith necessarily if it's not performed on a time schedule that we might like. There'll always be some kind of a hiccup, or invariably, not always, ideally not, but those are few and far between. We do have a watch list of other precious metals, so we will keep an eye on things like silver. We will keep an eye on PGMs. For those, I suspect it's rather less demand-driven commodity price performance, which will bring them back into investor focus as a supply constraint. And, we look at the gold sector and, where might bad news actually be good? If you look at the big PGM producers, which are mainly in South Africa, a lot of them are having their margins held at marginal profit levels from a chrome credit. Chrome grows into steel. We're not particularly bullish at all. In fact, we're probably bearish on steel. And if that feeds through to a weaker chrome price, then the received basket price that these platinum, palladium, rhodium, chrome assets produce will go down. And that, from a marginal margin, a slight profitability takes them into loss and hopefully hastens any supply correction that we feel is probably on the cards, because the demand side is actually weakening at the moment. Car sales aren't happening. Trade wars are disrupting the availability of lots of supply chains, and people just aren't spending on the big ticket items. So it's going to be a supply-led correction, and that's on our list of what we might shift into if we see the opportunities at the right time, at the right valuation.
Okay, yeah, I'm starting to hear a little bit more optimism about PGMs, so really good to go into that as well. And of course, you mentioned silver. We should talk about your outlook for silver, where you see the market going, and also exposure to silver and how you're looking at that right now, if that would suit you.
I'll briefly start on it, and I'm sure Rob will be able to add a little bit more to it. I mean, I wouldn't really dress the platinum group metals up too much at the moment. It's been on the watch list for a little while, and frankly, being candid, it's taking longer for the South African producers especially to curtail supply. But a stronger rand, they're often as sensitive to the rand as they are the actual metal prices, which haven't moved, but the rand has strengthened. Hopefully that will come along, but having had some recent meetings, we're not quite there yet for us. With regards to silver, it's a metal we do like. I'd say it's probably quite illustrative that I think it was in April there was a sharp correction because everyone was suddenly worried about recession and the impact that might have on the industrial demand that represents half of overall silver demand, as opposed to, some coins and some jewelry. But it's recovered very well from that. And again, maybe whilst the industrial side of things is coming under a bit of pressure, it might well be related to a supply correction there, which is beneficial to those equities that mine it. Often some 80% of silver is produced as a byproduct of base metals, or actually as gold as well. But if the base metals, zinc and lead, start to fall off, and to a degree some copper, then so might a large portion of that byproduct. The ratio to gold, I mean, frankly, at the moment, if you benchmark anything against gold, it's going to look cheap. It's certainly lagged, and that subjectively at least screens it out as a sector we'd like to own more of, but we actually don't own as much of it as we have done, largely because it's been diluted by the strong performance of gold in the recent year-to-date performance. I think our NAV is up something like 60%. So there's probably a degree of catch-up still to be had from silver, and we'll see if we can find some good investments as to where that is. A lot of the pure silver mining is actually geologically in places like Mexico, which isn't, we're kind of used to the politics over there, even if it's not particularly palatable.
Yeah, I might jump in. I guess it's topical because we've had a few strong days in silver, so it definitely feels like there's a bit of a bid under the silver price, and it's one that we do kind of debate on because it's not all pointing in the same direction. So, silver's different because it's over 50% industrial. It's the only metal that's a better conductor than copper. So it ties into very high-end electronics, and we're seeing that in wind turbines, in EVs. and undoubtedly going to be feeding through into kind of AI chips and build out. Although I haven't seen any kind of hard data on that because it's kind of still a bit early stage and unquantifiable. But so as a result, there's a really long term kind of bullish theme to silver, but in the near term, there's an element of caution. If we're kind of seeing a bit of a slowdown, does that kind of feed through into kind of some EV sales kind of slowing down? I do appreciate in China it's been very strong. We're also seeing elements of sort of thrifting, so that can kind of ease into that. We saw with Tesla, and this is one of the reasons we're a bit cautious on copper actually. But Tesla's going up higher voltage, so you can kind of drop down your actual copper usage because if you're higher voltage, etc. So there's all these kind of aspects. On the industrial side, we had an element of caution near term, but much more bullish medium term because there's a clear direction for many of those themes over the medium term. The real question mark is around kind of retail, and I think what we've started to see in the last couple of days, and this may be an element that gold's got pretty pricey. And we talked earlier about emerging markets and people looking to protect on their domestic currencies. We may be seeing an aspect now where we're starting to see a bit more retail flow coming into silver, because if you're looking to protect your value, it's kind of hard for people in emerging markets to buy gold in a kind of quantifiable amount that's comfortable because of the relatively high dollar value, especially in their own domestic currency. So this may be a driver to silver going forward. But yeah, I mean, Keith mentioned there that we don't have a huge weighting towards it. I think we're about sort of 8%, around 8% in our precious metal fund. So whilst we like the top down, we can see the direction. We probably had a bit more conviction on gold near term, but now we're starting to see the price action. Maybe it's suggesting there could be a bit more momentum to it. Primarily our caution has been on the bottom up, where actually a lot of the silver miners trade at material premium to their gold peers, as they have done for years. And we kind of question whether that's fully justified, whether a silver mine in Mexico, which has gone through political issues around, although it's improving now, had some negative headlines around mining policy, like at a government level, although it does appear to be easing. Does that deserve to trade at a 1.5 times multiple relative to operating in a different country? You can buy assets in Canada, gold assets in Canada at 0.7 times NAV. Is that kind of fully justified? And that's kind of been one of our issues and why we haven't got a larger weighting. Where we have focused has been more on a bottom-up side. So within that, I mean, from the North American aspect, I guess something like America Silver is something we think is very attractive. Yeah, that fits into kind of backing management teams. We do think Paul Hewitt's very good at driving a potential turnaround there. So that kind of gives a bit of a feel of how we look at things as well.
Great points on silver as well. I know that's a very tricky market. And as we're getting toward the end here, I want to ask if there are any other themes you're looking at among the gold and silver stocks. I was thinking maybe we could look at what's happening with M&A activity. I know there's been some deals. Curious to know if you think that we are going to see more M&A in 2025 and maybe what kind we could see.
Yeah, I'm happy to start on that, but feel free to add, Keith. So a lot of the M&A we've seen, I mean, if we look over the last 5 years, so a lot of the M&A has kind of been actually driven by the Chinese. The Chinese have been pretty active in getting foot on assets. Only more recently have we started to see M&A kind of pick up, other than a couple of the mega deals with Newmont acquisitions. A lot of it's actually been single asset companies merging with other companies, and we've had one of our largest holdings is Calibre, which obviously more recently has been acquired by Equinox at sort of more marginal premium. So it's not kind of a huge kind of takeout premium, because it's a bit more of two companies of not too dissimilar market caps coming together with a combined entity, hopefully attributing more value. So again, that's good management team there, and sort of Darren Hall, CEO. Calibre, solid operator, and we think that's another one that will do that should do well. But on the M&A side, so yes, it's kind of been more smaller companies that haven't been recognised because they haven't had index inclusion, have appreciated by merging one or two assets with another one or two assets. Suddenly gets you to a multi-asset company. you get a multiple uplift, you get index inclusion, you get more liquidity, and that kind of ultimately drives value to shareholders. So we've seen some logic around that, kind of G mining with Reunion, for example, any kind of getting to scale. So moving forward, I think we're going to transition to a bit of a new phase. If we look industry wide, we haven't seen hardly any growth really from the sector overall on a production basis over the last 6-7 years, and this is because it's difficult to grow production in gold. There aren't big assets. We've seen this structural issue for many of the larger miners in trying to add material production. They're having to transition more towards sort of copper gold porphyries in trying to do so. Gold price is high, balance sheets are strong, they're generating more cash, and they've underinvested for years on exploration and development internally because big companies just haven't been able to do it efficiently. So we do anticipate far more M&A to come down the pipeline. What we see more recently has been kind of them coming in and taking more 9.9% type stakes in some of the development companies, which we always refer to as the Agnico model, because Agnico have kind of done that for years, but it definitely feels like industry-wide there's a bit more uptake on that. But yes, I think we're going to see a bit more larger M&A, and initially probably coming in for producers because they still trade relatively cheap versus spot. So bigger companies sat on a load of cash may as well buy a producer because it's trading below NAV because no one seems to believe the spot price is translatable, and ultimately kind of see more stake M&A, kind of farm-in type deals into assets that may be 2 or 3 years away, and maybe dipping a toe into some of the earlier stage stuff, which we have seen Agnico doing with the likes of Collective Mining, for example. But yes, more is a conclusion.
Yeah, I think that's really helpful. And it gives us not just an idea of more, but kind of the how of how it could play out. So thank you for going into that. Really good. All right. I will let you go unless there are any final thoughts on any of the topics that we've been mentioning that you would want to leave investors with right now.
I was only going to suggest that coming back to your point on style, where we've invested outside of current producers and looked at some management teams that have previously delivered on some good assets that have come out in scale, we're now, I think, increasingly, when we look at things like explorers, honing in on assets that have real scale to lead into that M&A that you just touched on. So things like Southern Cross, we think it's 10 million ounces. Things like Collective that, Rob referred to there as having Agnico buy-in, that is something that we think will be a mine. And, he's a bit Marmite. You love him or hate him, Harry, but he's done it before in Colombia. And, that's the style of another style aspect to the investment process. Very good. All right. Well, we can wrap it up there if that sounds good to you, if we've covered everything that we want to here. The one thing I would make is just that when we refer to our Golden Prospect Fund, investors should note that there is a 1 for 5 embedded right on that trust, which come the 1st of December gives you the right to buy, for every 5 shares you own, 1 new one at 48 pence, which is about 10 pence lower than the current share price. So bear those factors in mind. There's another couple of years to run on that embedded right. But in that fund in particular, you've got a nice free option. Okay, very good. Well, I'll link the details in the video description so people can know what's going on there. Thank you so much for coming on to go over gold, silver, a little bit of the PGMs. This is really useful for me. Thank you.
Great. Thank you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Rob Crayfourd and Keith Watson.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.